understanding in other areas. Last time we had Marty talking about how he was utilizing contextual information to drive deeper or more interesting experiences around signing up and engaging events with Invite. Today, we have my good friend Paul Singh, who's going to talk about leveraging data and how he's leveraging data to drive insights and understanding around investing in privately held companies. And if you know Paul, this has really been a major interest in area specifically for him. Something I've known or seen him talk about, through his time as being a partner at 500 Startups, where he actually invested in my wife's company, Uba. Now he's now in DC and started Disruption Corporation and the Crystal Tech Fund. And he's going to talk a little bit about that and some of his ideas, which will hopefully then jumpstart some lively Q&A. But yeah, take it away, Paul.
Cool. Thank you, guys. Sorry I'm a little late. I suck at time management. So I'll just warn you right off the bat, I have a shitload of slides and we're not going to go through them all, but you're going to see me flipping around a lot. Because I really do want to make it super useful for you guys. So there's a lot of context here, but we can also just riff on whatever you guys want to talk about. So let me just set that as sort of the ground rule, by the way. That if you have any questions or comments or you just think I'm full of shit, just say it and let's just talk through it together. I'd rather you guys have a good time and kind of poke holes in this, and then we all just figure out how to work through it together. And if I totally suck too, I just get out of your way. As I understand it, I'm standing between you and your happy hour, is that right? That is true, right? It's like an awful position to be in. But anyway, yeah, so my name is Paul Singh. I grew up here in Great Falls, actually. Born and raised. Went to high school in Fairfax, went to college at Mason. I was the absolute worst student ever. And so about 15 years ago, started my first company. We were doing web hosting, which isn't very sexy today, but back then was sort of the cool thing to do. I ended up building a bunch of data centers in Ashburn. If anybody knows where Ashburn is, it's like about the only nice thing that's in Ashburn right now, there's only two nice things in Ashburn. One is it's 8 million square feet of data centers. So basically 70% of the world's internet traffic goes through there now. And I built about 1 million square feet of those data centers and sold them in 2004. I think the only other nice thing is like the Lamborghini and Ferrari dealership, but I do not have either one of those cars. But it's fun to drive by it every day. And then did that. I screwed around from 2004 to 2008. If I'm being very honest, I was a total asshole. I thought that since I made a little bit of money, that anything else I would touch would turn into more money. Turns out that's not how company building works. But I also forced myself to learn how to code over that time. Started building stuff. 2008, another one of my products kind of took off, and I was doing lead generation for blue-collar guys. Sold it in 2009. And that's where I kind of got to some of the early discoveries of where I'm at now, which is, if you guys remember, 2009 was when the market crashed, or 2008 was when the market crashed, and every poor person that was out of a job was now an entrepreneur. And I say that respectfully. But the thing was that I was trying to do angel investing at the time, and what happened was that, like, normally you might see like 15 or 20 people in a month that might want to raise some money. But that year, it felt like hundreds. It was like if somebody just found out you might invest in a company in the future, everybody wanted to pitch you. And so back then, I was just trying to figure out, I didn't have any VC friends, I didn't know how this worked, I just knew that I wanted to invest in companies. And so I did this novel thing, and that was that when I was investing, or when I was meeting founders, I just created this sort of taxonomy, and I'm just going to talk high level for now, and then we'll go into details. But I created this taxonomy of different sectors, and then as we were talking, whether they gave me web stats or revenue stats or anything else, I just put them in a spreadsheet, just an Excel file. And then what would happen is, over the course of like 100 pitches or so, you started to see a baseline emerge, right? So you could start to see, like, if somebody said to you that they had X thousand uniques a month and it was a consumer product, and then they said they have Y% return visitors, well, over the course of looking at 100 companies, you start to figure out, well, are they like in the top 5%, or are they like totally off the mark completely? And so the point is, I made 14 investments that way, and it worked. By the way, everything I say is public, but there's some stuff the SEC might hate, so I'll tell you when I say stuff that you probably shouldn't tweet. Is this being like live broadcast anywhere?
Yeah.
Okay. All right, so everything's fair game until I tell you that it's not. So, but you know, it worked out. So, all right, so we'll come back to that. So, high level, I co-founded a venture firm called 500 Startups. Now I run a company called Disruption Corporation, which manages a bunch of funds. So over the last 5 years, to get just to be really, you know, succinct, I've probably invested in about 760, 770 companies across 40 countries, almost every U.S. state. I think I've got, I'm on my 8th fund now, deployed about $115 million over the last 5 years, 4 years, 4.5 years. And I don't think it's a stretch to say that I've been one of the most active investors, most aggressive investors on the planet. Anyway, did some other stuff. Anyway, so let me just talk about data. By the way, a lot of the ideas you're going to hear from me come from a lot of these books. I sit on an airplane a lot, so I end up reading a lot, and I'll send the deck out and you look at it. But don't assume that I'm like claiming any kind of these ideas. A lot of this stuff is sort of a compilation of everything I've read about. So we're going to fast forward. So this is one of the biggest changes in the private market. And you guys know this more than others just because you are in the tech space and you have a shitload of data and you're already doing stuff with it. But most people in our industry, in the tech industries, or at least maybe in the online world, don't quite understand how much information is really available to them. So one of the biggest things that change in our world is that signals are everywhere, and more directly, transparency is everywhere. You know, if I'm being very blunt, I don't have to even rely on my gut feel anymore because I can just generally ask for your, you know, access to your Stripe account or your Google Analytics account. I don't even have to look at your pitch deck. I don't have to look at your business model. I can just like go directly to whatever platform you're using and knock it out. So this is one of my favorite things. You know, what we're talking about here is not groundbreaking when it's taken in the context of the public market, right? So let me just ask a question. What is this?
Walmart.
What?
I said Walmart.
Empty parking spaces.
Yeah.
Hey, you guys all seen this before? Oh, all right, never mind. Have you, or do you know that?
Yeah.
I haven't seen it before.
Yeah, you guys are good. Okay, so you guys may be one of the smarter groups to talk to today. I think on the other side of that coin, that means I only speak to idiots. So I'm probably not going to get invited back to this other thing. So, anyway, so yes, they are Walmart parking lots. And the reason why they're important is because a couple of years ago, UBS, which is a large bank, was getting a lot of questions about why their trading strategy was working so well around the quarterly earnings reports. So what this is that every quarter, publicly traded companies every quarter release their earnings statements, right? And so there's a huge business on predicting what the earnings statements will say because depending on which way those earnings statements are going to go, you either buy a lot of the stock right before and then sell it right after, or you sell a lot of stock right before and you buy it after. Does that make sense? All right, so traditionally what banks do is to get better at it, they'll send moles in and try to like socially engineer information from the local managers. They'll try to analyze like the suppliers. I mean, just look at all the little leaks on Apple, right? Like everybody wants to know, you know, who's making the Gorilla Glass and is that company doing well? Like, you know, the point is everybody's looking for signals. These guys, it turns out, one of the things that was most fascinating about their model was that in addition to doing all the things that all the other banks were doing is they were actually tasking a satellite provider to take photos of every Walmart parking lot every hour of every single day to count the cars. Right? It doesn't seem like rocket science, but in the public market, it was essentially the first admission that people were using more than just gut feel, more than just MBA type people to predict which way the market was going. It was sort of the first real admission, I think, that data was being used. What about this? Does anybody know what this is? Close. All right, I'm glad you think this one. All right, what's that?
Looks like an oil tank.
It is, yeah. So the tanks on the left there, so that is the oil field in Cushing, Oklahoma. The reason why that one's important is that when you watch the nightly news and they tell you the price of oil or a barrel of oil is X, right? That's typically the price of a barrel of oil in the New York Mercantile Exchange. And the reason that's important is the vast majority of the oil that's traded on the New York Mercantile Exchange is stored in Cushing, Oklahoma at that facility, right? So the picture on the left is of a plane flying over it. The picture on the right is a very old photo. That's why you can kind of see it kind of ratty. But if on the high-res version here, you'll see these are nets over the top to kind of prevent people from looking. But the reason why it's important is the structure of those tanks in Cushing, Oklahoma, it's a floating roof system. So the roof sits exactly on top of the product that's inside of it. Does that make sense? So when you look at this thing close up, you'll see there's actually hinges on that stairwell, and this thing can float up or down. Now, and these are actually, if you drive over there and or you actually fly over it, you'll see they're actually, you can see through them. They're not there for privacy, they're there for heat. They're like a trellis frame. Anyway, the reason why that's important is companies fly helicopters over those tanks twice a week and sell you that data on the roof level. And you can get it in XML, you can get it in RSS, you can get it in CSV, you can get it like they even have like a webhook, they'll just push it to you every time the helicopter goes over. And if you think that's scary, or it's actually kind of funny, if you go to their website, go to Genscape's website, not only will they sell you that, but they have ammeters, right? Like so, like they can measure currents, electrical currents, things like that. So they have ammeters sitting on public land under the power lines, and they'll sell you the power and the direction that power is going in and out of the oil fields. Does that make sense? If you want to get really scared, look at all the other products they sell too. And you can get all that data any way you want. The point I'm just trying to make is that every decision you make in the public market that is risk-based, there are people already using data against you. It's sort of like the most well-kept open secret out there right now. Right? So I'll just tell you on a personal note, by the way, that for those of you that are smarter than me, you probably hate that I'm going to say this, but I have no money in the public market. Not a single penny of anything I have is in the public market. And the reason is that, like, I just believe it. There's only two ways to make money in the public market. Option one is to put it in and wait for years, decades, and hope that maybe you make 8 or 10% a year on that. Option two is to pull out the big guns and basically have the fastest computers closest to the interchange and fight the machines. Neither of which of those are appealing to me. And so, everybody's like checking their 401ks now. But the thing is that I choose to be, I actually think investing in private companies is less risky because at least I can see it, I can touch it, and I can actually meet the founders. And so, anyway, there's lots of precedent here. You guys know most of these services, right? So let me just give you some broad examples, and we can get into some specific dip examples if you want. So when I make an investment in a company, right, one of the things I'll do is we have, that original taxonomy that I started out with on spreadsheets is now part of our code at Disruption Corporation. We have a central platform now, it's called Hubble. And what Hubble does is it pulls in structured data from services like this, and then it pulls in unstructured data that our analysts actually go out and find. And the reason that's important is, for example, is that once we've made an investment in you, let's just say one of you decides that you're going to leave the company and go start something else. Let's say we invest in you. The way that venture capital works is that we make most of our money on the second investment we put into you in your company. So we'll put in a little bit of money at the beginning, but it's like when your company starts to take off, we gotta put more money in. Now, if you understand that, or at least follow me on that, then you'll understand that it's important that I know when you might fundraise in the future. The problem is you're smart. And when you're smart, what you'll do is before you come back to me to say, hey, it's time to go raise more money, if you're smart, which you are, you probably will have talked to about 5 or 10 other investors first to try to create a market. So one way to kind of get around this, is that we actually track you on all of your social media. Now, this doesn't always work. But what we're doing is we know that the world of other investors is pretty finite. Does that make sense? Like the number of people that can give you $5 million is not infinite, it's finite, right? And we know generally 90% of who those players are. I mean, do you guys agree? They're pretty finite. So what we look for is intersections. You know, are you checking in at the same places that those people are? Are you getting tagged in photos with them? Are you exchanging a lot more tweets with them? Right? We start to establish these baselines. The point is, though, is that we pull in data from, like structured data, probably from 84, 85 different services now, just ranging from like stuff you know to like even obscure data aggregators. And the thing is, we just pull it all in because we don't know when it's going to be useful, and then we just have a rule set that just fires off anytime there's like an interesting event that happens. But the point is, we take all that data and then we roll it up with our gut, and we roll it up with other subject matter experts, and then we use that to make investments. By the way, you want to know what a bad signal is? In the early days, this used to work in the old days, but doesn't work anymore. Is we used to ask for access to your web server logs. To your cloud accounts. So what we wanted to do is like we would track your overall spend on Amazon Web Services or Rackspace or whatever, and the thought was that it would be an interesting indicator of performance. The problem is most people are so optimistic about like what traffic they expect that their actual server costs will just skyrocket way before anything ever happens. So it turned out to be a bad signal, so don't do that. But anyway, so it turns out a lot of us are doing it already. I'm going to just assert, by the way, that the use of data in the private market is probably the best kept secret. Because everybody wants you to believe that it's about your pitch deck and it's about your like who you know and all that stuff. And like, I'm just here to tell you that's such bullshit. Because like that right there is not a complete list of the firms that have data scientists and huge engineering teams on staff. That is a partial list. But that list still represents billions of dollars a year that's placed in private companies. Right? And so, I don't know whether you find that inspiring or scary, but that's good. That's good. So, venture capital is interesting because it used to be so venture capital used to be this industry that was about essentially rich people that were gatekeepers to money. And I didn't come out of finance, and I certainly didn't come from money. But I'll just tell you that, like, this is one of my favorite quotes from the guy that started AngelList. And disclosure, we're investors in AngelList as well. But AngelList is like sort of the platform. I would call it the New York Stock Exchange for private companies. Places a couple $100 million a year electronically. The point is, he made this comment a few years ago when he was just starting AngelList, and he said that like business model, the whole industry was going to change. There was going to be lots of new business models and new tech, and this was like sort of the beginning of even his, like this was even before AngelList ever took off. So it's interesting, is like his premonition is coming true, but it's changing the way we all think. VCs used to make a lot of money off of management fees, and now it's kind of a blend of management fees and other services. VCs used to be about pitch decks and business models, and now it's more like meetups and hangouts and more soft skills and stuff like that. I could go on forever. Let me just stop there and let me just stop there and just see what do you think? Which way do you guys want to go on this? We can talk about anything you want. We can talk about individual deals. We can talk about, I don't know, infrastructure. We can talk about whatever you guys want. What's best for you guys?
Well, what's your edge in this? Like, how do you? Everyone's doing it, right? Is it new data sources? Is it new techniques? Like, how do you differentiate?
Yeah. So there's a couple ways I can answer that. So let me actually just. It's funny. The next part of this slide talks about that. And I don't know, Justin, if you're going to yell at me if I'm going the wrong way on this thing, okay? Somebody yell at me if I'm going the wrong way. So that's where this comes in, this next slide, which is like, our industry's changed, and differentiation is kind of a weird thing. Let me just start by saying the state of the art in our industry is not very sophisticated at all. VCs want you to believe that what they do is like super special and secret, but like, look, I can put a spreadsheet in front of you and give you the right books, and I can teach you how to do VC in probably 2 weeks. Probably 2 weeks. To be fair, certainly there's a nuance to this, but let me just say it's not very sophisticated. most of them don't know how to code. Most of them don't know how to be operators. They're typically like book smart, but not, street smart, which is different because if you're in a capital intensive business, you need a book smart VC because you're going to deploy billions of dollars. In our industry, like tech industry, look, even though $10 million sounds like a lot of money, and it is a lot of money, relative to the other industries, it's pretty cheap to do a tech company. So it's interesting, it's not very sophisticated at all. Specifically to your question, it's really about access. And if I were to boil it down and be very blunt, I would say that I'm going to assume most of you, look, you guys work at a tech company, so by default, you're probably tech savvy, right? I'm going to just say that, like, first of all, I bet you can agree that if you put any other VC right there, and you're going to agree with me that my money is just as green as that person's money, right? So from your perspective as a founder, you don't really give a shit where the money comes from because it all looks the same when it hits your bank account, right? But I would assert that maybe you will hate me less because I know how to code and because we're more of a tech company that happens to invest in companies rather than a VC that likes tech companies. And so I would just say it doesn't really render right, but it's really about access. Everything else is all the same, right? But I think founders have more control today, and they have much more choice of where their money comes from. And so that's really how we differentiate. It's not speed to market or anything like that. I mean, certainly we make decisions faster than anybody else, typically within days, if not hours sometimes. But and that's because we just have all this data to go back and lean on. We've got analysts back at the office that help us with this. But it's really about access. I mean, if you think about it, the paradox of our industry is the best people that are worth funding, by definition, have maximum choice of where their money comes from. Does that make sense? So like, Uber's going through some shit right now with some of that stupid stuff they're doing. But on the financial side, when they want to go out and raise money, a lot of people want to pile drive money in. And in that kind of a fight, it's not the biggest pockets that win. It's typically the ones that have the best relationship with the founder, right? Whether it's brand, whether it's like Hangouts, whether it's whatever. And I would assert that that's what we have. Like, we don't have the biggest pockets in the world, but I would like to think that people hate us less than other VCs. It's like I'm aiming high, I guess. Yeah.
Yeah, you talked about the false flag of cloud spend as being not valuable indicator. Can you talk at all about red flags you see in the data where otherwise positive data indicators tell you might want to invest, but you see certain types of specific red flags that make you back away?
Yeah, I mean, like a really good, like the first example that comes to mind is, so is everybody familiar with the concept of B2B versus B2C companies? So you have consumer companies, business to consumer, and business to business. All right, so I'll just assert, now this is not a blanket statement, but just generally speaking, B2C companies, the founders of B2C companies generally need to have, for successful ones, need to have a really good understanding about distribution, right? So that's, you hope that they can tell you more about like how they intend to do their paid spend, their organic, their SEO, all that stuff. That's typically how that works, right? They have a deep understanding of user psychology usually. Now on the B2B side, what's fascinating is that notability and experience within their sector is usually the most important thing to look at. In other words, to your question, the red flag would be if other people in the industry don't know them or hang out with them, and or they don't have a lot of experience in it, that is a red flag. So what that means is, let's say somebody pitches us on a B2B idea. Well, what's happening is, so what happens, like the way that we collect our data, just a very rudimentary way that we do it is, if you're familiar with like Crunchbase and AngelList, this doesn't always work, but just generally speaking, what happens is most people, before they're ever going to raise money, they're a little optimistic and they'll register themselves on those sites, right? And they'll classify themselves and all that stuff. Our thing is our crawlers are gonna find that and then just pull them into the database. And after that point, we're tracking them, right? So now, generally speaking, they'll come to us about 90 days later if they've survived that long, and they'll say, hey, we want to go raise this money. Now, what will happen is over that 90 days, we've been crawling them. Now, the value of that data between day 0 and day 90 is 0 because we don't know who they are. They just like got sucked into our database and we don't know what we're going to do with that. But on day 90, when they show up, they're like, hey, I wanna do this thing, and here's what I got, or whatever. one of the first things our guys will do is go back into the database and try to pull all this sparse stuff together and try to create a fuller picture of who these people are. And right away, if we don't see that they're actually hanging out with other subject matter experts in an industry, that's a red flag. Doesn't mean we're not going to take the meeting. It does mean that we're going to ask a lot of questions about why they think they're going to win in this industry. And then also, if like for example, on their LinkedIn, we're not seeing any companies listed that are even in the same sector, then we're going to have some questions. Again, none of these things, don't let me convince you that the data can make the decision, because sometimes people don't fill out their profiles, sometimes our data is wrong, all that, but it does help us steer the question. You know, the irony of all this, by the way, is that like, if you want to know how VC works, we pull money in from like other people, so like they're typically institutions like big banks and pension funds and things like that, and these people are the furthest removed from technology. At the risk of saying this, I'll just say they're typically old white men, and I, to be very direct, am usually the wrong skin color and age to be in that room with them, but we have access to the deal flow. Now the interesting thing is, they don't understand any of this. In their world, they understand, they believe that venture capital is about looking at people's pitch decks and then looking at these financial projections. And the problem is that like that's not how it works in our industry anymore. You can go from like 0 to, you know, I had one company 2 years ago, I think the same year, Justin, that I invested in Lauren's company was, actually, this part's off the record. So there's a company called 9gag. Anybody know that? Pretty funny, isn't it? It's pretty funny. Probably a little inappropriate, but a little funny. So this part's off the record. So they, you know, when we saw them, I just took a flyer on it. It was kind of like, let's just see what happens. These guys seem really smart. At the time I met them, they were building a YouTube karaoke site. These guys live in Hong Kong. And so what they pitched us on at the time was this like YouTube karaoke thing. It was fucking hilarious. It was so good. And people would use it. People would use it. Like there were, you know, I think something like 10,000 uniques a day or something like that, which sounds ridiculous, but they were coming from an Asian country. You know, in Asia, for anybody that's been there, karaoke is a big thing, right? So the concept of YouTube karaoke is huge. I mean, it's huge. It probably sounds like a joke here, but it's huge in Asia. And so we're like, let's do this thing. Anyway, so we're like tracking these guys. And they're sitting in my office in California at the time. We're tracking these guys, and something hits. It turns out they have this side project. So they were trying to build ways to drive more traffic to, I'm forgetting the name of the YouTube site, that YouTube product. And again, keep this part off the record. So they were creating these like honeypot sites. The idea was put funny pictures up, like cats and everything else, and see where they can drive traffic to, and then they'll have like links that'll bring people back up to the karaoke thing, right? All right, so they do this thing. We don't know what they're doing. We just know that we've invested in them. They're doing the YouTube thing. That thing's growing. Anyway, they had registered on one of the. We also track, for example, domain registration. That's like ugly, but we just brute force it and look for collisions. Like we like to see when our founders are buying other domains as well. Anyway, we buy this domain 9gag. It doesn't mean anything to us until like a month later we see they're doing no shit 100 million uniques on that one little honeypot site. It's not like I like they're sitting in my office, like not that far away from me, and I'm like, hey, I was just gonna ask you. I think one of my crawlers was off, but like your Alexa scores just went through the roof, and your backlinks like are off the charts. Is something wrong with my stuff? He's like, no, man, check it out. So he opens up his, the Google real-time stuff. No shit, like the numbers are bigger than I've ever seen before. And I just remember looking at him and I was like, I don't think you're going to be doing YouTube karaoke anymore. And anyway, so they did, at the end of that first month, 150 million uniques. We weren't that far off the actual numbers. See, like, remember, by the way, with all the data that we collect, we don't have to be directly on the money. We just have to know directionally which way you're going, because a human will still have to get involved and understand whether there's a business there, right? But that's an example of how we would use data to find an interesting winner. Another red flag, by the way, is that when you invest in a company, typically a quiet company is a dead company. And that doesn't necessarily mean like if they're not emailing me, like sometimes they might not be sending me updates quarterly or whatever. That's not necessarily a bad thing, right? But regardless of B2C or B2B, there's always a baseline of how often a company is getting mentioned in the news or mentioned even in like obscure, tier 3 city newspapers. There's always like a baseline for every company. And what you can find over time is that once they start deviating, like the point is like no news is usually a very good red flag, and that's not though just the emails. Like a lot of investors will say, oh, I invested in this company, and they haven't like given me an update in 3 months. Well, that's not the end of the world. I mean, I barely talk to 9gag probably maybe once a year now, right? But that's I don't feel worried about that because like everything else is pegged up and to the right. If everything else went quiet too, and they weren't emailing me, then we'd have a problem. But does that sort of answer your question, or?
Yeah, that's something.
Yeah.
Maybe a question, I guess. One is like you talk about the kind of different data signals you've established. First part is how often you go and reassess them with new signals. Second part is how often you find that the people coming to you try to gain the signals that they know you watch.
Wait. Okay. So the first question was
How often you
Oh,
kind of have a
yeah.
baseline of factors and variables you look at. How often you go back and reassess and say, hey, here's a new data stream to look at.
Okay, so there's 2 parts to that answer, I think, if I understand you right.
Yeah.
The first is our engineering team is always looking for more signals, right? So we actually have 4 guys on our team that are, they're always like, I mean, they're on our engineering team, and there's always stuff for them to do. But one of the things they're always looking at is new data sources, right? So if they find some obscure endpoint or API somewhere, more often than not, they'll just, if there's a wrapper that's not already available for it, they'll just create one, open source it, and then just use it for our own good. So I would just say that's on a rolling basis. Like you never know when you determine like a new signal, but it's few and far between, right? I mean, I don't think it's like every day or every month. I mean, it's like one of the things we started to do, by the way, is when we look at the terms of service on, there's like a free service, like one of those terms of service watchers that we use. And so like if, let's say Crunchbase's API has a certain number of limits on it right now, right? Like I think right now it's like 25,000 hits a day or something like that you can do. And then our API wrappers are designed to like not, we just want to be good. We don't want them throttling us, we'd rather throttle. But then what we'll do is there's this other third-party free service that's like a terms of service watcher. And we'll just manually set an alert in there to tell us when the TOS changes. And I think it changed recently. I think it changed last week. Something changed on it. So one of those 4 guys jumped on it right away to just kind of go look. It turned out there's an aggregate endpoint now available, and that actually allows us to. So the point is, though, is that we're always keeping an eye out for new signals and or like changes to the existing APIs that we look at. The second question was.
People start to gamify the signals
Yeah.
that they watch.
Yeah, well, actually, right before that, you asked about how often we, I think, look for the. I think what I heard as a second part to your first question was how often are we looking for like events in that data?
Yeah.
So that's an interesting question. So don't judge me on this, but right now, basically, all of our filters are we have essentially this big long rules engine. And by rules engine, I just mean a cron job that like runs. Now, technically, it runs every day, but actions don't, like things don't fire off every day. I mean, I think what will happen is we have a human look at every company once a quarter because we have to do that. Like under just the way that VCs work, is a human has to look at everything at least once a quarter. But the jobs run every day, and we just look for collisions every day. So we have a set of interesting things, and every time, like if one of my investment guys is like, oh. I think this one kind of interesting intersection of data points might be fascinating to watch. Anybody can just create a new row in that job, and then when it just runs every day, it'll just fire off an email to the investment team. So daily is the short answer to that. Daily for automated stuff, and then quarterly for human. And then the second part of your question was, did it gamify it? Yeah. So yes, yes. We try to be really open about what we're doing, and we hope that people are going to gamify it. The problem is like tech people are smart, so like typically what we end up having to do is like, unfortunately, like it's a choice between choosing like the shitty option and the less shitty option. So the really shitty option would be we'd have to actually write code that looks for all the potential ways that people could game the system. The way that we've actually chosen to do it is only humans can identify if there's a false positive. So what will happen is if any of our rules hit, the investment associates look at it. So when a rule hits, an engineer doesn't look at it first, an investment associate does first. And when they're taught, the first thing they're taught to do is to verify that it's a real event and not a false positive. If it's a false positive of any kind, then they need to actually go back and flag it for an engineer, and we have to go back and look to see if it was either, maybe one of the endpoints gave us the wrong information, or it changed, or maybe the founder really was gamifying the system a little bit, or trying to mess with it a little bit. But we look for false positives first, before we assume that it's actually all true. If I'm being like very direct, I would say that like throwing tech at the problem, we just don't know how to do that just yet. It's like, it's not that big of a problem. It hasn't become that big of a problem yet, but so we've been throwing hamster, it's like that, we call it the hamster solution. It's like, until people really start screwing with us, which I think is a bad sign. If they're spending more time trying to game us, that's probably a bad sign anyway, but for now, we'll just keep throwing our people at it to try to solve it. You guys are probably a little bit different, I imagine, where you have to deal with like bots and stuff, and sure. Luckily, we haven't had to deal with that problem yet. Yeah.
If you look at this data the other way around, assuming that you're tracking trends by vertical, could you potentially find niches that are ripe for disruption?
Yes, 100%. So if you look at our strategy, actually, look, you just look at it. Let's keep this part off the record, but it's not a secret, it's just we don't talk about it. My first 3 funds were designed to be what we call global flagships, so they can invest anywhere in anything. They're very broad, very broad. And then the next 5 became more niche specific. So, but they became regionally focused. And then more recently, we've started like AngelList syndicates that are vertical specific. The world is going to become more niched out. Now, I don't think that the code, like just to address one comment in your thing there, I would say the code and the data hasn't helped us figure out which verticals to cover. We still have to have a human do that, right? Because like somebody has to decide whether there will be large enough exits within a certain niche for us to then write more code to track that niche, and then for us to also go raise money to invest in that niche.
If you're, let's say, tracking social mentions and things like that, you could correlate social mentions versus how many companies are actually working to solve that problem.
You could. I'll tell you, I'm not that smart. You know, one of the first things we did was we realized that like women-founded companies were not getting a lot of attention. So we actually built a women-focused fund. Off the record, by the way, 27 exits now. We've returned 3x cash on cash, off the record. 50% of that, and that's in 4 years. For anybody in the math world, that is really good for the VC industry. Half of those exits came from women-founded companies, and half of those women are married to their co-founders. Like that's niche, and that like I know that's going to sound weird, but like most VCs don't think about it that way, right? And so we just look for the underserved markets. And I say it with all the respect in the world to the women. It's like we give them the same pricing structure as the men, all that. Like nothing changes based on gender. But we basically look to see where other investors are not going. Here's another example. I set up a fund in India actually in 2012, 500 India, and the reason is that like there's still a lot of danger in operating in places like India because the legal structure is a little bit looser than ours here and things like that. But the interesting thing is that we believe that the pricing. So what was happening is American dollars were going to India, and then these guys were going in and trying to buy into the companies at a discount. So they would essentially say, they'd be like, oh, look, you're in India, so whatever you're building is going to be a third of the price of something like that in America. And they could do that because they were like, they're one of the very few sources of capital. And we started to see Sequoia and Axel and all these guys go over there, and we were like, fuck that, we can destroy that. And we understand the culture a little bit better, and like we're not price sensitive. We'll pay the same amount, we'll give you the same valuation in India than you will in America. So the point is, humans still have to be involved. By the way, on that note, never compete on price. Because like somebody else will come in with a cheaper, like a cheaper product anyway. Like the race to zero is so fast, it's like it can like make your head spin. So like we won in India, I think, because like we just weren't there for a discount. But the problem with India and places like that, by the way, our algorithms had to be changed at the cultural level. So sorry, our rule sets had to be changed at the cultural level, not the country level. So this is interesting, right? Because we thought, so, like a lot of the rules, like who's hanging out with who, that sort of thing. In America, now I'm going to make a very broad statement, right? In America, in general, whether you believe it or not, people are pretty accessible, right? Meaning like you could text somebody or email somebody and there's a good chance that they will respond to you. It doesn't matter how important they are. They'll respond. Maybe they'll have a beer with you. Maybe they'll even take a picture with you at an event. That'll happen. In India, culturally, it's so different. Like, there's this like weird cultural totem pole where like if you're not considered to be at the same level as the other person, you're never going to be in the same room. Like it's just not going to happen. It doesn't matter. It's not going to happen unless like you have a relation, like some blood relation that's going to make it happen. And so, like if you remember what I was talking about, like watching who's hanging out with who, that doesn't even work in India, right? So what you have to do, we actually had to apply weights. So weights, W-E-I-G-H-T, weights to the different facets. So all of our data, all the data endpoints we roll up, and they're just different facets of data. And so at the cultural level, we had to then apply weights. So the world in our data set is defined as, the 5 major cultures are defined by language. So English, not in order of importance, but English, Mandarin, Spanish/Portuguese, they hate that when I say that, but we just lump them together, Hindi, and Arabic. And those cultures, they just all behave a little bit different, so we had to weight the data a little bit different. That was a big problem. And I lost all of 2012 working on that weighting system because we just didn't realize the scope of the problem until we actually went overseas. So anyway, I know I went all over that with you, but I would just say I think software or data helps our humans make better decisions about which niches and verticals. But we haven't yet figured out how to like get the system to tell us when some sort of niche is getting really good. Yeah.
So this may be a little oddball question. At the beginning of the talk, you mentioned how there's just a finite number of players.
Yeah.
I know in the news about half a year ago there was discussion about like federal regulations was easing for investment. Does that impact the private market at all, or?
Yes, but not yet. So the question was really more about like more players coming into the private market. So yes, it's affected it, but let me kind of answer it with a few numbers. So let's start with a definition. What is the difference between an angel and a VC? So an angel and a venture capitalist, what's the difference?
When you
I'm
invest?
standing between you and the boobs, I know. So. Anybody, it's not when you invest. Yeah.
An angel investor is investing your own personal
You got
capital,
it.
and then a VC is investing.
You got it. So you're 100% right. I'll just change it a little bit and just say that when you're investing your own money, the federal government doesn't care. You can do whatever you want. It's your money within a few reasonable things. The government says you're on your own. The minute you invest somebody else's money, you're under federal oversight, under the SEC, right? And the reason why this is important is that tech companies used to be very expensive to start. Okay, so for those, I don't know, like 15 years ago when I started my first company, to get on the internet, I don't know, I feel like I'm going to date myself here, but like, you had to buy a server. You guys seen those? It's got a box. You guys have hardware?
Yeah.
So, are you guys on Iron or are you on the cloud?
Yeah, about 1,000.
So you what?
About 1,000.
Okay, I think you said 100,000. Fuck. You have a data center, is what you have. So anyway, you had to buy them, you had to slide them into a rack, and there was literally a cable in the back that was the internet, and you like plugged it in, right? The point is that it used to cost like $1 million to start a company. Even more than that, right? So the point is, today, now you have you have the cloud and you have open source software. We usually tell people it takes no more than 10 grand to start a company, and most of that's like your laptop and whatever coding classes you probably took. And so, if you understand that, first of all, that relationship, that tech startups have gotten cheaper to start, what that really means is individual angels are now much more able to get into the game. So if it used to cost $1 million, then right off the bat, you could assume there's not very many people that are willing to write $1 million check as an angel. And there's just not that many people like that, right? So VCs, the people managing other people's money and big pools of money, they're sort of the gatekeepers. Now, the numbers. So in 2010, when you raise money from angels, let's just say you started a company, let's just say you don't want to deal with VCs, and let's just say you want to go around this area or whatever and go get individuals to put money in, you could probably get $500,000. And it would take you a lot of work to do that, but you could do $500,000 from probably 8 to 10 people. And that was the norm, by the way. Today, it's weird not to see a founder go get at least $1.5 million from angels. And that's because as the cost has come down, more and more players are coming in. So the other trend that's happening, by the way, is that I think tech is going mainstream. So people are now realizing that tech's not those nerds in the corner, but the future of this country. And that's changing. So anyway, it hasn't made it that much easier yet. So the thing is that under the federal regulations, technically you have to be what's called an accredited investor. Now, I'm not an attorney, so don't tweet this next part. But the way the rules are generally written right now is the government says that if, let's say I'm a founder of a company and you're the investor, the way it works is under the current rules, I just have to say, hey man, are you accredited? And all I need to know is that you nodded. Because the burden of proof is on you, right? So you have to be able to bring out, again, I'm not an attorney, you shouldn't do that. Right? But that's how it works, because the burden is on you as the investor. Me as the founder, as long as I don't know anything that precludes you from investing, fuck it, take your money. But that will change. I think that law hasn't come into effect yet because the government wants to change it so that I have to actually ask you for your tax returns. And never mind the fact that I, as a founder, don't want to do that. More importantly, you don't want to have your tax returns and your social security number on file with me for 7 years. So anyway, so that's a long-winded way of saying that there are new rules, but it's not really helping the market right now. But it will change. I mean, I really do think that the private market today, so I'll just make an assertion right now. I believe that the private market is one of the last ways for the average person in this country to make a shitload of money. It is one of the last ways. I mean, it is the new gold rush, right? Did you know, by the way, I haven't actually done the math on this, but a lot of the reports that are coming out of the VC world, Shark Tank may be the most, on a dollar per dollar basis, may be one of the most successful firms, or at least in the top quartile. As much as I hate that fucking show. They're getting pretty good. I think it's really more about, their picking is not very good. Sorry, I should say it a different way. It's not that their selection ability is better, it's that they have the media power to drive lots of traffic to the sites, and so that by winning, you, for a consumer company anyway, by winning, you assure yourself a large customer base.
It's almost like the recurrent theme in most investing, right? Like I've seen lots of inferior companies come and get the cool investors, and then they market just from that reach.
Yeah, you're absolutely right. In fact, if I were to go a little off topic, I would actually say that applies to your personal careers now too. I think that we are all marketing companies, individually, we are all marketing companies that happen to do whatever we do. We're not actually, career professionals that happen to have a Twitter account. Does that make sense? Because, think about it. If you're, that's the power of open source, by the way. Is it in the early days when we didn't have Twitter, and this is early days, 5 years ago, 7 years ago, when we didn't have Twitter and blogging wasn't all that easy, one of the fastest ways for an engineer in a small town to make a name for himself or herself was to commit open source code out there. Right? It was sort of like this democratization. And then blogging, WordPress took off, right? And now your ideas in general could get as much as that guy's ideas on the internet. Right? And then Twitter, and it kind of grew and all that. So anyway, I'm going off topic, but I would say that not only is it true in the investment world that you want the investors that can move markets for you, but even in your own personal careers, I would implore you to just consider the idea that notability might be more valuable than credibility. Right? But don't misunderstand me. You must be credible. You must be able to do what you can do. You must be able to do that. That is not a differentiator. Yeah. But notability is more important. Does that make sense?
It's almost the biggest value add for an investor, right? Aside from your money is marketing.
That's right. That's right. I mean, I can tell you, so this part's off the record, but I'll just tell you, what we've learned over the last few years is that just statistically across 700 companies now, plus companies, if I give you $50,000, typically within about 10 to 14 day period, another $534,000 will show up. If I give you $250,000, then at least another $1 million will show up in that same time frame. It just, the market follows. That was probably the biggest mistake in our models, that we didn't anticipate the public, we didn't anticipate that other investors would move as quickly to adapt to our model. And it changed the way that our follow-on strategy worked and all that. I don't want to get into like dilution and stuff like that, but that was in hindsight, that was one of the biggest oversights I ever made in all of our statistical models, was that we just never anticipated that the private market, other private market investors would adapt so quickly to what we were doing.
So do you get out of investing and just make this a platform, and then seriously, take a share of other investors' access to it?
You're smart. What do you do here? So yes,
Investing as a service.
So what Disruption Corporation is that we are a registered investment advisor, and we provide a central platform where we provide research, advice, and asset management in-house. So other funds already hang their hat with us. You may or may not know it. Sometimes they have, like today, we signed a $3 billion fund. It's publicly known. You hear about it on the news all the time, but they actually sit on our platform now. They just don't want anybody to know about it. And that's because we provide centralized back office and access to more research and deal flow than they can see themselves. So yes, the more crude way of saying it is that the private market is a gold rush now, and I'm slowly switching from mining for the gold to just selling the shovels and the jeans now. We're gonna do it all from here now. I don't want to travel anymore. Yeah.
You're talking one more question? Or?
As long as nobody's like throwing me out, yeah.
Okay. So just a question just for earlier.
Yeah.
You mentioned, I don't know if I quote this correctly, but you said
if it sounds smart, I'm taking credit for it.
A quiet company is a dead company?
Yeah.
Is that correct? Or is it a silent company, whatever it is, something along those lines? Can you give me like a specific example of like in your experience, like working with these companies, like ones that have created a lot of buzz and grown really quickly, like what was like a really creative way they did it? And then can you give me also an example of like what a company should not be wasting their money and time on in order to create buzz? Like what are successful creative ways and very unsuccessful ways?
So one of the things I want to say right away is I want you to understand that anytime I make a statement, it's important to understand that the inverse is not always true. So I just want to make very clear, by the way, that if a quiet company is a dead company, it is not true that a loud company is a successful one. Because we know a lot of really loud companies that have just failed anyway, right? So I just want to make that statement really clear, is that the inverse is not always true. Now, so your question was about loud companies and the ones that have made it? Or was it loud companies that haven't made it?
Well, it's just put in context. So you look at like specific metrics.
Yeah.
And these are like signals for you.
Yeah.
Like what are good ways to increase those signals? Like so, let's say like Twitter, or say like what are the best ways to get those on? Like so, as a company working here, like how can I contribute to like increasing those kind of things to get more buzz? And then like what should I not do?
Yeah.
Which should be like, oh, don't use Google Ads. Like that's terrible, or that's a great idea.
I'm just trying to think of the most succinct way to answer the question. So, have you ever read this book? It's written by this guy named Gary Vaynerchuk, and it's called Jab, 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 Right Hook. Have you guys read this book?
Heard about it.
Okay, so all right, look, save yourself. Don't buy a lot of copies. Buy one copy. He's not going to hear me say that, so don't. But anyway, buy one copy. But the reason why is the thing you got to respect about a guy like Gary is that he is so analytical about how the different platforms work. So in that book, see, look, it'll take you an hour to read. It's low on content and heavy on numbers. But the thing is, though, is that he basically divides the book into all the different social platforms: Facebook, Instagram, Vimeo, YouTube, whatever, right? And then he deconstructs a successful post or a successful piece of content on there and an unsuccessful one. And it's not the actual studies that are important, but rather the methodology he puts in. And this is probably not the answer you're looking to hear, but what I would say is that the best the best growth techniques are only visible in hindsight. And I'll tell you right now that even our own founders don't talk about them until they're not useful anymore. So let me say it in a more direct way. And this is not what you want to hear. But if you read about a growth hack on the internet, it means it's not effective anymore. So now the opposite way to say all that, or maybe the more constructive way to say that is, the best thing I can tell you is that so I'm assuming you're on the digital media team or something.
I'm a designer.
Designer, okay. So you know, the rookie answer is split test everything. But I think the smarter answer is like, I think you have to view all the channels, the distribution channels, as like their own beasts, and you're going to have to make an educated guess about what works. Like I'll tell you, like Twitter has become one of the best for VC. Twitter tends to has been like the best thing for us to get our brand out there as a VC. We've experimented with video, but I can't get a good ROI on it. So we tried originally like founder stories that we would post on YouTube and other things, and the thought was we wanted to like get other founders to like see us as thought leaders and things like that. The problem is that like they're crowded. Discovery is really hard on those video channels right now, and it could just be that we just suck and we don't know how to deal with it. But I would just say you have to look at every platform separately, and if there was a silver bullet, I would give it to you. But the only commonality I see with founders in their growth, the growth teams, anyways, is that they're very analytical at the per channel level, and they tend to be the first to sign up for new platforms. This is maybe a broader point that will apply to your distribution and your personal lives. It's really important that you understand that the world is not normally distributed.
No, there are failures.
So here's what I'll say is that, like, you know, I think it was Einstein that said that compound interest was the eighth wonder of the world. I think it's bullshit. It's actually the Powerball. And the thing you have to understand is that, you know, a few things you do will generate an outsized portion of your returns. Like a really obscene example, 1% of the music industry takes 77% of the revenue. Right? One or a maximum of 3% of your investment portfolio will return 300% of the money. Right? So the point is, you have to apply that to your personal lives and your professional careers too. Is that you have to take sort of this like systematic approach to the different channels, and you've got to figure out quickly which channels are worth trying, and it's worth being the first to sign up for different platforms, because that first mover advantage is huge. In the distribution world anyways, it's huge. I know that's probably not what you want to hear, but there is no easy path. That's the problem. If I can just make one more depressing statement, I'll just say that like, you know, the world's just harder to build stuff in now. It's like the challenge for all of us, you know, I'm going to say is like Americans now as well, is that like, you know, if you think about what we did, let me just frame it around data. I think we as a country have built, like, we should all be proud. I'm going to assume everybody's American or whatever, like, gives a shit about America. I would just say that, like, we should be proud of the fact that over the last 20 years, we've built some of the world's largest tech companies. Some of them, not all, but some of them, right? So if you take the Fortune 500 list on the New York Stock Exchange and you sort it by overall revenue, you will get the industrials, pharmaceuticals, Caterpillar, all that sort of thing, right? You turn it around and you sort it by earnings or profits, and all of a sudden it's all tech companies. It's the Facebooks and the LinkedIns and the Twitters and things like that, right? We should be really proud of that. Now, we should also remember that the vast majority of those things, like the PayPals and the Amazons, we built it on a population of 350 million Americans. Now, that's a little bit of rhetoric because not all of them were online for the last 20 years, but the point is, we had the world's first monetizable internet consumer base. We had the best credit card policies in the world, and it resulted in, look at our GDP, right? Let's not get into like what the bad things are. Now, here's the thing. You have to understand that places like India are 4 times bigger than us. With a middle class, they have more students in their school system right now than there are American citizens. Some of the, just today, Mercedes launched their new S-Class Maybach. The most expensive Mercedes you can buy. Where was it launched? It wasn't America, it was China, right? But Alibaba, you guys saw that? You guys saw how big that is, right? That's like bigger than like the top 3 tech companies in America put together. The point is, that's not to say that we should be depressed. The point is, we should use the data and the knowledge that we have as Americans, as American company builders, as American tech professionals. We should use that data to help these other countries build their best companies. And that, I think, to be very direct, without having very much detailed knowledge about the business models of AddThis internally, I would just say that I would suggest that that is really the growth opportunity for a company like you guys, sitting on the kind of data that you have. But you're making a lot of money on your clients right now, but maybe it's worth considering putting an outpost in the BRICS, right? Brazil, Russia, India, China. and let's put Asia as well in there as well. And thinking about how you take your data and you help those companies get out ahead of their competitors. That would be really interesting. Anyway, I've talked way more than the 5 minutes I was told to. So I'm happy to chat anytime you want. I'll be around for a while too, but I'm just Paul at disruption.vc. If you want to go via email, I'm Paul Singh on Twitter, and I live in Ashburn and I work in Crystal City. So I'm always around. If you guys want to just shoot the shit, I'm happy to do it. But thanks for the time.
You guys want to hang out and have some drinks in the kitchen, feel free.